Good morning, ladies and gentlemen. Thanks for inviting me to Waterloo. This morning we're going to have a full morning on exit strategies, which is 401 in the new NACO course numbering. As Rob said, we're going to actually have 2 breaks. So, and if we could, what we'd like to ask is for you to hold your questions until the end of a module. Part of the reason is we want to do the best job we can capturing the questions for the at-home audience on the video, and that'll also give me a better chance of staying on schedule and getting all the way through the course and not running over time. As Rob said, the Angel Academy is an important new initiative of the National Angel Capital Organization, and we're all passionate about angel investing, and we all think that angel education is a key part of creating a vibrant, healthy angel community, which is essential to be part of the entrepreneurial ecosystem and the future of our economy. The Exit Strategies module is the module that will hopefully give you the take-home knowledge and tools to improve the rate and success of the exits in the companies you invest in. What we hope is that this is the first of a 2-module set, and the second module is going to be on exit execution. And one of the things we'd appreciate today is, as the course is being delivered, if you could keep an eye on your evaluation form, maybe fill it out as you're going. And we're particularly interested in section 6, which is the place where we very much appreciate your input on future courses in this series. This is a little bit about me, but I'm going to talk a bit about my background as we go through the program to help you understand where I developed the perspective I'm going to be talking about. And the session this morning is broken into 4 modules. We're going to first talk about why only 25% of saleable companies have successful exits. Talk about how things have changed in the last 5 or 10 years. Hopefully convince you that every company should have an exit strategy. And then talk about exit timing as one of the most important parts of exit strategy. And the first thing I hope to give you as a piece of knowledge that enhances your angel returns and enjoyment in the future is an observation that you probably haven't heard very often before. But that is that only 25% of saleable companies successfully exit. Yes, I'm saying that 75% of the time, when entrepreneurs and investors build a company that could have been sold, we blow it and fail to successfully exit. And that's not the worst news. The worst news is that when a company fails to exit at around the optimum time, there's a terrifying probability that it won't just fail to exit, but it will fail completely to go out of business. So what I'm saying, and perhaps my greatest contribution to the future of angel investing, is the observation that if you look at the companies that were our successes, the companies that were worth selling, the companies that would have produced a positive return, that's the universe we're talking about. That might only be 20 or 25% of the companies that we invest in. But just talking about the winners here, half of them will never exit. Of the ones that do exit, half of those, a quarter of the total, are going to be what I would call a poor quality exit. And only 1/4 are successfully sold. And I think that's pretty terrifying and pretty depressing as an investor. But I'm guessing that right now most of you are thinking, why haven't I heard that before? Why isn't this more widely known? And who is Basil Peters and why is he saying these things? Well, the first thing I want to try and get across is that entrepreneurship is exploding all around the world. And certainly here in North America, I think Canada is a leading part of this trend towards more people working in the modern type of company. We see now lots of universities, especially the ones that you have here, offering undergrad and grad courses in entrepreneurship. And a few professors in North America that are starting to conduct some really serious research on entrepreneurship. Like what works and what doesn't work. How can we create more successes and have fewer failures? And there's a few nonprofits that are starting to fund some early research and to capture some data. But the reality is, we still don't have the hard data that we need. And when I say hard data, what I mean is that what we wish we had was a big database that tracked startups all the way through their corporate life cycle. And it included data on how the companies were financed, what their strategies were at different stages of their development, and how well they executed those strategies. And then, based on that observation through that company's life cycle, see what happened at the end. And if we had this big database, we could start to do some analysis, and we could start to correlate the strategies and behaviors with different outcomes. And what that would start to help us understand is which strategies had the highest probabilities of entrepreneurial success. And then we could start to develop some best practices. Unfortunately, it's not going to be that easy. I have the luxury of spending some of my time interacting with some of the finest academic researchers in the world who are studying entrepreneurship. And it's pretty exciting to get together with them and to talk about what we need to do to capture this data. And some of them are trying to work on parts of that. I'm sure many of you know Rob Wiltbank, one of the leading researchers in this area. He did the first angel returns study in the US and in the UK. Rob and I love to talk about this type of thing. The challenge is that this would be an extraordinarily difficult data set to capture. And the first reason is that what I just described would require us to follow companies all the way from their founding, all the way through their life cycle. And on average, that's probably the better part of a decade. And we'd need to track each company in some uniform way. Like we'd have to be able to say, that's the same strategy here as this company halfway around the world's deploying. We don't even have words to describe what that means. And we'd have to measure those companies at every stage in their evolution. And we'd have to consider things like the success of their product strategy, even their HR philosophies, and the environment in which they're operating. Even the quality of the CEO and the board would have a significant impact on the outcome. And and that's what we would want to do to be able to learn what worked and what didn't work. But even if we could do that, even if somehow somebody put the money together to fund that research, I'm not sure if it would be that helpful. Because the other factor that's important, and I want to have us think about this morning, is that the world's constantly changing. So let's imagine that we ran this experiment in the 90s. And we had a decade where we spent, this would cost tens of millions of dollars, by the way, to do this. So let's say we did that. Let's say we captured all of the startups in the country. We looked at whether they were bootstrapped, angel financed, venture capital financed, and we looked at what happened to them. I'm pretty sure that if we had done that study and we asked ourselves which strategies worked best, the answer would have been the best strategy is to go public. No question that through the 90s, that was the best financing strategy, that was the best exit strategy. And so if we built that big database in the 90s and discovered that the best strategy was to design our companies for an IPO, we probably would have published that around 2000. We would have gone out to all the entrepreneurs and said, build companies to go public. And of course, everybody's smirking because that would have been the worst possible strategy to have for the next 15 years. So if we can't build a big database, if we can't do what we learn to do as scientists and engineers and researchers, how do we learn? How do we learn to be better entrepreneurs and investors? And we can't wait for the academic research. I think that's pretty clear. Even if we started now, most of us would be retired before that research was useful because, again, one data point is going to take us a decade. So we're going to have to probably have a couple of life cycles, like 20 years worth of data before you could even start to do some data mining on that. So what it all means, what angels and entrepreneurs have intuitively always done is we have to rely on anecdotal observation. And what that means is that we have to make the most important decisions in our businesses based largely on our observations and discussions. And I think that's why meetings like this are so important. And that's why organizations like GTAN and NACO are so important. Because they provide us an opportunity to interact like this and share our observations and discuss strategies, to exchange ideas on what's working in today's economy, to challenge each other, to apply our collective observations, to build the best practices that we can build today. And to tell you a little bit about myself and to explain why I'm here saying these things, I've been fortunate in my career. One of the things that I measure myself in being fortunate on is that I get to be here today and interact with you, having conversations like this. What I'm passionate about is finding ways for entrepreneurs and investors to be more successful and to have more exits, to make more money, and to have more fun. That's what drives me. That's why I flew 3,000 miles to be here with you today. And to tell you a little bit about myself and how I came to be doing this, I'm a geek, techie, nerd, whatever you want to call somebody who's been fascinated by technology from a young age. And I got my PhD in electrical and computer engineering at the University of British Columbia, and because I was born and raised in Vancouver. I was a serious student and did quite well in my academic work, and started my first company while I was still in grad school, literally in the lab where I was working. And that company grew pretty nicely. We actually got to be the second largest manufacturer of cable television head-end equipment in the world. So we built the central electronics for cable television companies like Rogers and Shaw and TCI and Time Warner. And I was fortunate to sell that company in '93 to our biggest competitor, and they were then subsequently acquired by Cisco. So the company that I started in grad school, I get a lot of satisfaction out of the fact it's still running, still vibrant today. Some of the people that I hired right out of school are still working in that company today as part of Cisco. And when I sold that first company, it was the first time in my life that I actually had any money. And I was a poor kid that grew up in East Vancouver, and then I was a typical starving student. And then I'd been an entrepreneur where every cent that I could borrow was in the company that I was running. And so when I first woke up after that exit and actually looked at my bank account and I had money that I had to think about what to do with, I changed what I was doing in my career and thought that I wanted to be a fund manager. And I had spent a very enjoyable 5 years running a hedge fund. I didn't get to interact with entrepreneurs, so I realized that was an error, sort of changed my strategy and actually started a venture capital fund, which I ran, and I ran the tech portfolio in that company for about 3 years, very successfully. But I realized that really what I wanted to do was run an angel fund, and I started an angel fund actually with external investors, reported on the results, and that was a much better fit for my personality. But what running the venture fund and the angel fund helped me understand was that what I was really interested in learning how to do better was the exit. And now what I do with my work, the work part of my day, is I run a boutique M&A advisory firm in Vancouver, and we mostly sell Western Canadian tech and knowledge-based companies. And the reason I wanted to tell you about that is that through my experience as a fund manager and now for more than 2 decades as an angel investor, I calculated one day that I've actually watched 1,000 company presentations. And that was pretty terrifying to realize how much of my life I've sat in rooms like this watching some entrepreneur with a PowerPoint. I've made about 100 early stage tech investments in my career. Slightly less than half of those produced a return, which I'm very proud of, because if you can get to slightly less than half, then it's working. And I've also been involved in about 100 company financings, and I mean involved like helping the entrepreneurs to do financings. And more recently and more impactful to me is now I've had a chance to work on several dozen exits directly, like hands-on, help companies through that whole process. Another thing that I've been fortunate about is I've been a member of the YPO-WPO, Young Presidents Organization, a peer-to-peer organization for CEOs for about 25 years. And that's a very secretive organization. To build the trust we need to share, we agree we'll never talk about anything ever. And of course, I would never violate that. But what's interesting to me is that after living through decades with peers who were also CEOs, I learned a lot about how the average company's exit experience unfolds. And so it's those two ways that I've been gathering data on what is happening in my local community. So I was born and raised in Vancouver, still live there. And when I was running a venture capital fund, I actually had a team of people whose job it was to go out and look at every investable company every investable tech company in that region. And I don't think my team ever really did the job that I kept trying to challenge them to do. I think they might have gotten to about half. And I've also belonged to as many as 4 angel groups for many, many years. And I say as many, I can't quite get to all the meetings anymore. But what I've been doing is the geeky, nerdy engineering me, just been throwing all that stuff on my hard drive now for decades. So I've got a pretty good set of data on all the companies that I came across, both professionally and as an angel, that were investable. And what's also been interesting to me is, I'm getting to be fairly well known out west as the guy to talk to about the exit. So all my angel friends bring me their companies and say, hey, what do you think? Which is a lot of fun. And it also, again, gives me a perspective on which of those companies were actually saleable. And one of the things I wonder sometimes is whether or not it's different in Vancouver, say, compared to here in Waterloo or somewhere else. And I've come to believe it's not different. I think that the market for the exit is actually a global market. And one of the things that has been interesting in Vancouver is that in British Columbia, we've had an angel tax credit for about 20 years. And part of that tax credit process captured the data from those companies, did a pretty good job at capturing their cap tables, investment rounds. And there are some researchers at University of Victoria and University of British Columbia who are mining that data. And while it's not what we wish we could do because it doesn't have all of the data you'd need on what the companies were doing, what it has done is it showed us that the exit rates, like how often a company actually has an exit, isn't any different in Vancouver than in Silicon Valley to a pretty high degree of accuracy, or Boston. It's pretty much uniform, which is what you'd intuitively expect. So I think the experience that I've had is just as good as if I'd grown up in the Valley or grown up in Boston or grown up here in Waterloo. And this is what that experience has taught me. First, I learned early on in my life that being an entrepreneur is hard. I know many of you are, and I think that was probably the same kind of feeling you had when you were building a company from scratch. But being an investor is even harder. And to be more specific, in my experience, investing is easy. I think I could find a company, fall in love with it, and write a check every day. I think the hard part is getting your money back. And I think that that's because the hardest, and I think perhaps most important part of the whole process, from starting the company, conceiving a product, finding a market, financing that company, growing that company, the hardest part of all is getting the exit right. And that's why I'm excited about trying to help learn about that part of the entrepreneurial process. And I want to just remind you again that what I can talk about here today is not hard data, it's anecdotal observation. I don't have a database. I have a lot of raw data, but I'm not trying to suggest I've got a database that says it's 25%. What I do know is that it's far less than half, and probably more than 10%. So when I say a quarter of successful companies have a good exit, it's somewhere between 10 and 50%. So this is observational, anecdotal data. It's the best we can do right now. Saleable is also, by the way, a matter of judgment. There's no scorecard you can apply to a company to say whether or not that company was saleable at that point in its history. But 25% is the best data we have. So the point that I'm hoping I'm helping you to appreciate is that we're still learning how to be good angel investors, and we're still learning how we can help the entrepreneurs be more successful. And I'm an entrepreneur, I'm an optimist, so for me, the good news is there's lots of opportunity to get better. If you're a glass half empty guy, we're blowing it 75% of the time. And one of the things that makes this difficult, one of the reasons that we're not very good at this last part of the process is that exits just don't happen very often. So we don't have much data. And probably only 10% of the companies that we angels invest in have an exit of any type, successful or unsuccessful. And the other thing that makes this very, very challenging to learn about is that each observation, each company that we learn about from an exit perspective, we have to watch for 5 or 10 years. So if you think about it and compare it to financings, we participate in multiple financings a year, often. And whether we actually write a check or whether we just work with our fellow angels, in a year you might see 3 or 4, 5 financings up close. But if you think about how many exits you've watched up close, even the veteran graybeard angels or that rare serial entrepreneur, it's 1, 2, 3 is really how many we get to see up close. And even when we think about that data set of maybe those few observations we have, it's important to remember that not all of these exits are happy ones. And lots of times when you read about an exit or you hear about an exit at a conference like this, about half of the ones you hear about were actually distressed sales. And they were exits where what I consider unsuccessful is when the investors don't get their money back. You read about a big exit, sometimes it's a headline in the newspaper, and the angels are, they're all kind of grumbling because they got back 0.75% of their capital 5 years later. I don't consider that a success. That's not the kind of thing we want to emulate. But we see these stories in the press all the time. And some of them were even just orderly wind downs. You see these big headlines, exits, but it wasn't. So what I want to do here is talk about the successful exits. So when I say exits, I'm going to be a little bit relaxed about that, and I'm not even going to be talking about the things that lead to the unsuccessful or unhappy exits. I only want to talk about the successful exits, the type that you want for your companies. And for me, that's just very simply an exit that actually happens and is fair to the shareholders. That's my definition of a successful exit. And one of the banes of my existence, and one of the other reasons that it's so hard to learn about exits, is the accursed NDAs. When we do a financing, it's pretty much open information, open source. Companies talk about raising money, angels freely exchange information about the terms and the valuations. All that's easy information to access. The problem with the exits is that most of the time, the details are covered by a non-disclosure agreement. And a big part of the reason that I'm actually running this boutique M&A firm in Vancouver is I want more data. I want to be able to get hands-on and see what's actually happening out there in this part of the ecosystem. But what breaks my heart is that a lot of times when I get this really wonderful case study, this thing that was going to help lots of other people learn, I end up under that same non-disclosure agreement because everybody gets captured by that big net, and we can't even talk about some of the best stories. So even though when I have my team sign an engagement, we actually put the case study right in the agreement. It's not a binding part of the agreement because we can't bind people, but we state at the outset, part of the reason we're doing this is we want to build a case study. And I am fortunate, though, that I do have some really excellent case studies. In a small fraction of the time, the moon and the stars align, and we have an exit where the transaction is not under an NDA. And that's kind of a magical sweet spot where the acquiring company was most likely a public company, and the transaction was large enough to be material. In a case like that, under the securities laws, they have to disclose everything. So in a few cases, I've actually had CEOs or chairmen that I've been able to interview, and I've got some video on my blog about their experiences and where we've actually been able to go through and write up a valuable case study that I hope is valuable to angels and entrepreneurs because this data is so elusive that we need to do whatever we can to find ways to get more of it. And it is, this cumulative experience is what I can talk about in workshops like this. So I can talk about the general observations, and I, of course, can share the specific case studies. So what I think this means for you is that we're all still learning. And the part that we're least good at is the exit. And on average, to remember that of the companies that we build that could be sold, we only get it right around a quarter of the time. But what gets me excited and out of the bed on the weekend to do writing or working on something like this workshop is that I think we can pretty easily get to 50%. I think even coming through this workshop is going to move your needle on the percentage of your portfolio companies that actually exit. At least that's my hope. That's why I'm doing this, because I believe I can make a difference. And ultimately, I think organizations like NACO and G10, if we kept doing this for a couple more decades, we might be able to get to as high as 75%. We'd be able to develop tools, best practices, and maybe then we'd only blow it 25% of the time. And of course, what that would do for our angel portfolio returns, what that would do for those entrepreneurs, even what that would do for the economy, I think would be very significant. I think the overall GDP of the country would be better if we didn't squander so many of those opportunities just because we didn't have the knowledge. So my goal today is to provide you with the take-home knowledge and skills to increase the probability that your companies will have successful exits. So you'll have more exits, make more money, have more fun, and be able to help the entrepreneurs be more successful. Any quick questions on that first section? Comments, observations? Sir?
You use the qualifying word, companies that could be sold. How would you define the eligibility to be sold?
Excellent question. What I'm trying to say when I say saleable is a company that if that company's board understood the opportunity and if they ran a process, they would have a successful exit. So a company that could have been sold, a valuable company, a successful company, is what I mean when I say saleable. One that could have been sold, and where the timing was approximately right for the company to be sold.
Are you suggesting that the board and the CEO and the prospective acquisitor didn't get it all right together at the right time?
Absolutely. A big part of the time what happens, and this is coming up more near the end, a big part of the time what happens is we grow these companies, they become saleable, they go through the peak in their value, and the board, the entrepreneurs, the angels, they all miss it. These are private companies. There's no stock ticker. It's hard to know what's happening. It's also difficult to put it in the perspective of the market. But for a combination of reasons, which I'm hoping to cover today, for a combination of reasons, we miss it. Other times, I think as you're suggesting, perhaps, the execution of that business process is not done well. The company is saleable, and the board and the CEO don't execute. Again, we're talking about entrepreneurial companies, and there's we don't get it right every time. So that's another one of the reasons that it should have happened, but it didn't happen. Another quick question, sir.
What percent of companies you've been involved would have be a successful company and not exit or not even want to exit? In other words, be able to write a dividend check, every year, and everybody's happy that way.
Great question. So the question is there a definition of successful where the investment leads to a dividend? And yes, that is certainly theoretically possible. I have seen that once in my career. And the reason is that there's a very small subset of companies that are the kind that can generate a dividend to an angel and not put themselves in extreme peril. And so it's just something that doesn't happen very often. I think it's something that entrepreneurs strive for far too often, to build a company that will actually cash flow. I'd be curious, how many people have made an investment as an angel, not as a entrepreneur? How many people have made an investment where the result was a predictable, stable dividend stream? That's kind of my experience. Yes, it could happen, but it doesn't happen very often. And even if you had a company that could do that, even if you had a company that had, let's say it's quite profitable, I would say in the vast majority, maybe 80, 90% of the time, the smarter thing to do would be to sell that company. And the reason is that in this market, you're going to get that future value of that dividend stream. You're going to get that right now. And so what you're doing is you're de-risking it. You're not letting all those things that happen in business, and we all know that in business stuff happens, you're taking that out of the equation. So I still think that it would have been probably a better strategy to sell that future stream in a market like this. In 2008, 2009, entirely different answer.